simultaneously. So without further ado, I'd like to present to you a couple of reference documents and other information that I submitted to you. And they're available on the back end of our website. And they will allow you to get PAID. Now, first, we're going to bounce out here. And we're going to look at something that, even though our Tier 1 and Tier 2 classes and sessions were canceled this past week because I was out on a brief tour, I want to go over the information that I had tech support go ahead and send to you anyway. So I went ahead and had the reference documents drawn up, and this information is available on the back end of your website, of our website, for your perusal. I sent you a PAID alert about this information as well. And yesterday, during our Classroom That Was radio broadcast, I made mention of something called the, right here, the dogs of the Dow. And in your reference document, number 2 from our Tier 1 class and session, as it relates to the class that was canceled this past weekend, I have a reference document in there that tells you how you can rebalance your portfolio utilizing the dogs of the Dow. So let's go over this reference document, all right, to make sure that this is firmly entrenched in your thought process so that you can go ahead and start looking at rebalancing your portfolio at the beginning of this year so that you can go ahead and can continue to get PAID. Now, I recommend that you rebalance your portfolio or look at rebalancing your portfolio at least once a quarter. So that means you would be looking at rebalancing your portfolio a minimum of how many times per year? If you're looking at rebalancing your portfolio once per quarter, greetings, Queen Jillian. Greetings, King Art. There you go. Think about it, Mike. Once per quarter. How many quarters are in a year? There you go, King Elder Gary Smith. There you go, King Garnell. 4 times per year. Now, that doesn't necessarily mean you have to rebalance your portfolio 4 times a year, but at least look at it once a quarter for possible rebalancing. All right? Everybody clear on that? Okay. All right. Now, let's go over this reference document, because I make reference to something known as the dogs of the Dow. The dogs of the Dow. All right, here we go. We all know we're supposed to buy low and sell high. That's easier said than done, of course. Rebalancing is the next best thing, and it does indeed work. All right? If the market conditions are changing, you have to rebalance your portfolio to accommodate those changes and continue to get PAID. To put it simply, rebalancing calls for bringing your portfolio back to its original asset allocation mix. All right? If you think about it, over time, some assets in your portfolio will appreciate or rise faster than others. And let's face it, some will even decline. Rebalancing, beloved, brings your portfolio allocation back into alignment. There are a number of reasons to do this, so let's look at a hypothetical example to better understand and understand. Let's say you open an investment account. You decide that the ideal allocation for your portfolio is 50% U.S. equities and 50% bonds. I highlighted this. Note, the exact portfolio allocation for stocks, bonds, and cash should largely depend on your own time horizon and your risk tolerance. Nobody knows your situation better than you do, all right? So don't think that this is written in stone, 50% equities, 50% bonds, or 60% equities and 40% bonds. No. It is person and situational specific. Now, a year passes in this hypothetical. The stocks in your portfolio did well, but they now occupy 55% of your portfolio. This is partly due to some stocks that did well, but a few of your bond holdings also underperformed. You might be okay with this for a year, but if it is left unchecked, you may find yourself with a portfolio that is way out of whack relative to what you intended. You may check your portfolio a few years down the line and only to find it suddenly way overweighted on equities, so much so that you're uncomfortable owning that much in stocks. This is why it's a good idea to rebalance periodically, okay? And rebalance how many times, or look at rebalancing how many times per year? How many? There you go, 4. There you go, Queen Zenobi. There you go, Devon. There you go, Michael. Look at, even if you don't do it, but look at rebalancing your portfolio 4 times a year, once a quarter. Now, if you haven't considered rebalancing already, a new calendar year is a great time to do it. Now, as referenced earlier, one way to rebalance is by selling off a little bit of your highest performing stocks at the end of each year and scooping up shares of underperformers. Not only does this rebalance the portfolio, but it can also result in a higher portfolio yield. Let's look at the popular dogs of the Dow strategy to see how this works. Okay, so we're going to go over the dogs of the Dow strategy. Let me explain. At the beginning of the year, investors follow this strategy by buying the 10 highest yielding Dow stocks. On the last trading day of the year, they sell and then buy the next highest yielding Dow stocks. Now, the logic behind the Dow, the dogs of the Dow strategy is twofold. First, it relies on the idea that the Dow Jones Industrial Average represents inherently sound stocks that will eventually come back. And second, those stocks higher than average dividend yields mean they are oversold. So essentially, this strategy is predicated on the thought that the underperforming stocks with the highest yields are likely to be at or near the bottom of their business cycle, and that their currently depressed prices and abnormally high dividend yields won't last. The resulting portfolio has a higher yield than the Dow. Now, all this sounds good in theory, but does it really work? Well, with the decades of the 2010s just coming to a close, this is the opportune time to review. So a portfolio comprised of the 10 highest yielders in the Dow Jones beat the overall Dow in 7 of the past 10 years. Therefore, overall, the dogs delivered an average annual return of 15%, outperforming the 13.4% return of the Dow by 160 basis points. So, while the dog strategies may be considered old school, it clearly works. Oh, and in case you were wondering, here are the official dogs for 2020, dogs of the Dow. And here they are. Dow Chemical, ExxonMobil, IBM, Verizon, Chevron, Pfizer, 3M, Walgreens, Cisco, and Coca-Cola. All right. Now, if you were looking at putting these dogs of the Dow in your portfolio, all right, which ones would you look at and why? There are 4 in particular. There you go, Mike. You never cease to amaze me, my brother. Which ones would you look at? Okay? Which ones would you look at? Think about it now. There you go, Zanobi. There you go, Eagle Eye. I knew you'd catch it. There you go, King Allens. And there's go, my elders. All right. Listen, the elders are answering the question correctly. All right. Our cutoff, ideally, for our yield per stock. There you go, Queen Jillian. There you go, Queen. It's 5%. Up from 3%. Now, if the 2020 dogs of the Dow are going to be considered for inclusion to your portfolio, complete for the appropriate drill down, you go with those that are over 5% and those that are closest to 5%. Keep it in mind, we have now indexed above 3%. So the ones you would be considering would be Dow at 5.12, ExxonMobil at 4.99, IBM at 4.83, and Verizon at 4.01. Get it? Everybody understand and understand that? Greetings, King Al. All right? Okay, so everybody else, listen to what the elders are telling you because they're giving you correct information here now. All right? Okay. Now, this is all fine and good, but rebalancing also requires discipline, beloved. And unfortunately, more discipline than most traders and investors possess. Luckily, there's a solution. There are a number of ETFs that follow a similar strategy. One of my favorites is the ALPS Sector Dividend Dogs ETF, trades under the symbol SDOG. SDOG. OG, okay? Now let me show you how wonderful this position is. Come right over here to holdings. Well, first, let me walk you through the whole thing. Let's go through the profile. Bunch of powerful information here now to get you paid. All right? The investment seeks investment results that replicate as closely as possible before fees and expenses the performance of the S network sector dividend dogs index. The underlying index generally consists of 50 stocks on each annual resolution date, which is the third Friday of December each year. The underlying index stocks must be constituents of the S&P 500 index, the leading benchmark index of the U.S. large capitalization stocks. The underlying index methodology selects the 5 stocks in 10 of the 11 GICS sectors that make up the S&P 500 with what? Which offer the what? The highest dividend yields as of the last business day of November. Check and mate. Get it? I'm giving you all the information, so you come right here to holdings. You get ready to lock and load. You scroll down, bam. You see how closely weighted they are? So what you do is you look at the ones, you come down this list, and you find the ones that have the highest dividend yield. Don't get it mixed up with the percentage of weighting in the macro position. But you, let me ask you a question. If this says dividend, right? And you're looking for a list of dividend paying stocks, right? Wouldn't it make sense to come right here, go to holdings, and then you got a whole list right there? Think along with me now. Then you take this information that I've just given you with regards to this macro position, then you drill down with regards to the dividend requirements that we have, which would be what? Dividend of 5 or more. You're going to drill down. Dividend that has been being paid for 25 years or more, or bare minimum 10 years or more. Then dividend that has been increased 25 years or more, 10-year minimum. Bam. And then if you want to go ahead and bundle them all up together on a macro play, you come here. Bam. Get it? Thank you for the positive comments. See, family, that's why you come in here in this virtual trading room privately, so I could show you this now. So there should never be an excuse, well, there's so many dividend paying stocks, I don't know which one to pick. And that, look, I'm giving you a macro position that contains a list of dividend paying stocks contained therein. Not to mention, we know where to go also, right? To go ahead and get PAID as well. Right? Do we not know about this website right here? So there is no way we should not be able to reach out and touch any type of dividend paying position with the yield we so desire, and then insert same into the foundation of our portfolio for security reasons, okay, to base our foundation soundly of our portfolio and get PAID. And bull bear, we don't care. And then on top of this, we have a strategy unique and unto ourselves is that with the Asset Wealth Institute family, known as our dividend option trifecta strategy. There you go, King Mike. Shareholder record date, call option, dividend payout date, put option. And then we come back again and hit them again on the ER date. Maybe call or put, depending upon our drill down. Now let me pause. Any questions about any of this so far? All you got to do, family, is just implement the strategy. Thank you, family members, for the positive comments. See, family, we don't care about all the drama in the market. Just get paid from what's going on. And don't get sucked into what's happening with the impeachment hearings or what's happening with regards to, the lawsuit pertaining to Boeing and the jets falling out the sky and all. Democrat corn cow. No. All that stuff will get you distracted. Know your strategy. Study. Paper trade. Come back and then use just a little bit of money. Double that money, utilizing our strategies, and then you're off to the races. But don't deviate from the core concepts of our strategy. It's the reason why these strategies are the way they are. Okay? Let us continue. Oh, yeah. We're not finished yet, boy. We're going to have a good time in today's virtual trading room. All right? All right. So, SDOG applies the same dogs concept, but instead of being limited to old school Dow Jones companies, the fund tracks the 5 highest yielders within each of the 10 sectors of the S&P 500 for a total of 50 stocks. That includes the 5 highest yielding tech stocks, healthcare stocks, real estate stocks, etc. And here's the nice thing about SDOG. The ETF rebalances every quarter, just like I recommend you look at rebalancing every quarter. Taking whatever discipline we made or may not have out of the question, because they automatically rebalance even if you don't rebalance. No, there's more to this strategy than just putting extra dividends in your pocket. Yields are equally tied to distribution levels, so you're also investing in companies with rising cash flows that are lifting payouts. With value out of favor relative to growth, SDOG has struggled to keep pace in recent years, but the tide has begun to turn. The fund, which offers a healthy yield of 4%, posted a gain of 24% last year and is well positioned to deliver attractive gains again in 2020. Family members, this reference document is on the back end of our website, along with the rest of the reference documents for our Tier 1 and Tier 2 classes session, which was canceled this past Saturday. But I wanted to make sure that you still got the reference documents, even though we didn't have the classes and sessions. Okay? Any questions on this? You are all very, very welcome, family. We are your community service, okay? Excellent, excellent, excellent. All right, now, I also had tech support put this reference document up, and then I sent you a PAID alert. King Charles Davis, ideally we want them above 5%, all right? Because we used to index at 3% on the dividend yield payout. So ideally you want to look at 5% or above, and in that one instance, we allowed the 4%. You see right here on the dogs of the Dow, the one that was 4% in the reference document. Okay, all right. Thank you, King. No problem. Okay, now, as you know, we started this year, 2020. Every Monday, I will send you a earnings report reference document for the week. It's in essence a cheat sheet. And out of all of the ERs that are being released during a particular week, you will get those that A, have paid us consistently, including the last quarter when the earnings were released, and B, that have the highest probability of getting you PAID during the week that the ER for that company is going to be released. Now, the thing that I want you to adhere to until further notice is our Ask the Wiz Wealth Institute ER residual. There you go, residual strategy. All right? And I highlight that. I'll always remind you right here. I say continue to utilize our Ask the Wiz Wealth Institute earnings report ER residual strategy. Now, go on the back end. If you haven't printed this out, you need to print it out now, because you already missed Tuesdays, because some of these ERs came out Tuesday, and I had this sent to you on Monday. Okay? There you go. All right, many of you seen you already have. All right, great. Now, let's recap before we get started, and we're actually going to do a drill down on a position live right here inside the virtual trading room while the market's open. But before we get started, does everybody understand and understand how to implement our Asset Wealth Institute ER residual strategy? If you don't, let's refresh on that. Okay? We're about to take it to the market now and get paid. And we will be paid by 4 o'clock today. This is an intraday strategy. Do I need to go over anything? King Cathy says she's already getting paid from IBM this morning. That's great. That's great. Greetings, Queen Kamisha. All right. Queen Jacqueline says she's getting paid too. There you go. That's what I'm talking about. All right. Now here, we've got a question here. Question about which expiration date to choose. Okay. The third Friday of this month, okay, will occur this Friday, right? Hold on. Let me make sure I got my right calendar. Yeah. Okay. So, well, technically, yeah. Technically, it's going into the 1, 2, 3, the 4th Friday. All right. So you'd be rolling into February. Okay. Anytime is 1 week or less before the third Friday of the month. In this instance, they got 5 Fridays in this month. You roll to the next month. But with this, it's not a problem because we can set a close anytime before that time frame. Great question. Any other question? All right. Okay, here we go. Let's take a look now. This is the reference document I sent you. I give the day and whether or not the earnings report is going to be released after the market closes, AMC, or before the market. I give you a brief synopsis pertaining to the company as it comes up to the earnings report. All right, on each one. See right here? Johnson & Johnson, tomorrow before the market opens. Abbott Laboratories, today, before the market opens. Okay? Tomorrow before the market opens. Just low-hanging fruit money, family. Tomorrow before the market opens. Tomorrow after the market closes. All right? Now, here we go. We're going to start with, let's pick a position that has released their ER today before the market opens. Okay? Now, you could also do those that released their ER tomorrow, or yesterday after the market closed. Because when the market opened up this morning off the rip, all you got to do is implement our residual strategy and you get paid. So we're going to do one that released this ER yesterday after the market closed and one that has released this ER today before the market opens. Now, family, what you're about to witness will show you how easy it is utilizing our strategy and technique to get PAID from this document that I submit to you every morning, every Monday morning, okay? A lot of times what I'll do is I'll submit it like Sunday, okay? So you can be locked and loaded come Monday when the market opens. So now here we go. All right, which one do you want me to do? You want me to do IBM or do you want me to do Netflix? IBM or Netflix? Okay, we got a whole bunch, we got to split. All right, I tell you what, we'll do both. All right, start out with IBM. All right, old Big Blue released their ER last night. okay, after the market closed. Therefore, we're locked and loaded on it first thing this morning. IBM. Now watch this. Because we're implementing our residual strategy, we're letting the market play itself first. Okay? We're betting on the horse after the race has begun. Now, is that up more than 0.50? Next question. Is it 10 o'clock Eastern Standard Time? All right. Yes, it is. Let's go to work. Now, we come down here. First thing I want to look and see, did it hit a 52-week high today? It did not. Right there is the 52-week high. If it had hit a 52-week high, then I got to come back and I got to check the 1 month to see if I see a definitive run up like this and say this was the 52-week high, they coming to get that money. All right? Because nobody gets paid till they sell the clothes. All right? But because it hasn't hit a 52-week high, now I got an indication that some may stay in the position. There may be a slight sell-off, but they may push it higher. Because people are waiting for it to hit the 52-week high before they take all their profits out. All right? Notice the salient points now. Watch how I move now. I come down next, I got to check my volume. What is pushed it? Do I have volume? Is the volume today higher than the volume per day? You damn skippy. See it right there? All right. I'm locked and loaded. Now I come down. And as I look at this immediate jump, I know this is direct result of the earnings report. They must have had a positive ER report. That's more than 0.50. It's checking all the boxes. So now I come out. If it's at 144, I see where it came in. It closed yesterday at 139, opened at 143. So when I take my call option, I want to be at or below the last. Now listen to me very, 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 very closely. Unless and until this position pushes up to its 52-week high, this thing is going to continue to run because the fundamentals from the ER that pushed it up 4% will still be there this afternoon, tomorrow, and the next day until it gets close to its 52-week high, and there'll be massive profit taking. So I come down inside, up under at 144. Watch how I move. I get over here to the option. Now, if you don't see the options, okay, category, click right here. It will appear right there. Click on it. Now, as it relates to the question earlier asked, okay, well, what option contract do we take? All right, get off of the January 24th and get to the third Friday in February here. First, second, third. We index off the third Friday of the month. When I click on that, what did I say? I want to be at or below the last. The last is at 144. I kick back out. At or below the last. That will put me at 140. Get it? I kick over. I come in. Watch how I'm moving now. It has gone straight up. It's up 78.72%. See this? Now, I come back down. It opened at 405, went up to 603. So people who bought it this morning at $405, it went all the way up to $603, and the market hadn't even been open 1 hour. Now, depending upon how close it is to 603, the intraday high, that's going to determine whether or not I take it now or I wait. Watch how I move. It's at 588. Good. Good. Now, since they no longer, many of the platforms no longer charge brokerage fees for option trades and stock trades, all right? If I took this position now, watch now, it's slightly delayed. That time's slightly off. It's 10:05. This says 9:42. But let's just say it's still at 5.88. You would quite naturally call your brokerage firm to get the most accurate price. But it would cost what? $588 to take this position. Because with options, everything will multiplied or divided by 100. So one contract would cost 588. Now, the difference between 588 and 603 is how much? Break out the calculators. This is very, very simple, okay? Very, very simple. So you take 603 minus 508. Everybody with me? Okay, so that's $603 minus 588. So that means if I took this position and the position ran back up to and broke its intraday high, I make $15. Now, this is where you got to be smart. If you know the fundamentals that ran it up to 603 on the front side of the water table will still be there. They're going to be there on the back side of the water table. And you know during the water table, the position will have the propensity to fall. When this call option falls, will this price go up or go down? Oh, we getting with it today. We getting with it. It will go down. And when it goes down, with the fundamentals being the same, that's the time to take the damn position. If you're not already in it, don't go and buy it now at 588 just to make $15 when it runs up to 603. No, no, no. You use the market against itself. We know positions have a propensity in water table to pull down. Make water table your friend. There you go, Charles. You let it go in the water table. When that thing pulls down, then you come in and get it. 540, 520. Okay? Then when it comes back out at 1245, and the same fundamentals that pushed it up to 603 will still be present, then now you got a differential from 540 to 603. Okay? And now you're cooking with grease. All right? So now what you got is 540 minus 603, and you make $63 instead of 15. Y'all get it? Jared Griffins just checked, and the trading range is on his platform is 644. That's even better, baby. That's even more money. Now let's stop. Does anybody not get what I just done? Do you not see how I check down on this position? How I'm using everything from water table to call option strategy to average volume over the last 3 months versus volume per day, days range on the option side as well as days range on the underlying stock. Does anybody not? We're showing you this real time now because you best believe it's 10:09 now. When this thing gets to 11:15, 11:40, it's going to do this. That's what we want. Then we come back in and let the same fundamentals that ran it up here run it back up. That differential from where we buy and where it runs up to at the water table, that's called arbitrage. That's your profit. And don't you be sitting in this position come 4 o'clock, you out of here. We clear on this? Excellent, excellent, excellent. Wait a minute now. So the volume will push you back up to the intraday high. Yes. Exactly. Because look now, see, the fundamentals, the analytics that pushed it up at the beginning of the day, you think they changed between 9:30 and 12:45? No, it's the ER fundamentals. See what it say right here? How they gonna change between now and 11:45, 12:45? It ain't. So you monetize. Got it? Oh, thank you, Art. And King Art has reminded everybody. Don't forget to put your trailing stops on your position. Thank you, King. True family indeed. All right? Working like a village. Don't forget to put those trailing stops up under you. Now, let me ask you a question. Where should the trailing stops be? Come water table time, you come in there, you take your position. You want to keep your trailing stops wide or tight? Whoa, L. Thank you, brother. Thought I'd get you on that. See, when you go in the water table, you set your trailing stop wider. 20 to 40%, 30% sweet spot. When you get on the back side of the water table and it starts moving up, you tighten it. Boy, that was a good observation. Everybody get that? If you go in the water table and you run your trailing stop tight, you're going to get stopped out. But when you come on the back side of the water table, you know that the position is going to move back to the upside. So once it starts moving to the upside, that's when you come in and tighten it up. No problem. That's why we here studying together. That's why we so wicked with this thing when we get paid, because steel sharpens steel. Okay? We train hard when we come to this virtual trading room. And that was a good question. Everybody got that? Now, if you don't understand the rhyme or reason or rationale behind that, you need to ask it now. Because see, it's nuances like that. If you're off kilter with them, you will lose money. We don't lose money in the Wealth Institute. Not this family. Okay? Now, several of you have already said you're getting PAID from IBM, and that's a wonderful thing. But let me say this to you now. Those of you that have already got your call out, listen, that have gotten your call options on the front side of the water table, listen to me carefully. Don't you let that trailing stop stay wide. If you're already in your call option, you making double-digit profits right now, okay? Don't you let this profit go in the water table and you sitting with your trailing stop wide, because what's going to happen when you go to the water table, this is going to go down. So if you leave the trailing stop wide, you're going to start letting your profits erode. You're going to lose money. We don't give back money. So what you do is you tighten up that damn trail. When 11 o'clock, 11:15 roll out, you tighten that trailing stop up. And I'm so stingy. I will tighten my trailing stop up to 10%. I don't care, because I'm not giving back the money. It ain't happening. And if push come to shove, I'll lay in the cut and wait to right around, okay, 12:40, and I'll pull some money out and buy me another contract, another call, and then let them pay me again on the second go round. Okay? If I wanted to double up on IBM, if I just want to go ahead and take my money from the first go round, my first call, then fine, I move on, I lock and load on another position. But I'm not giving money back. I'm not going to let my trailing stop be wide going in a water table, and I've already got a call, and then they take back some of my money through erosion. No, that's not even an option. Excuse the pun. Do we understand and understand that? All right, let's do another. Let's do Netflix. All right, Netflix. Okay, here we go. Just did IBM. And IBM released theirs last night after the market closes, which allowed us to monetize it first thing this morning. All right, now let's go to Netflix. They also released theirs. Y'all want to do Netflix, or do you want to do one that's released their ER this morning? You want to do Netflix too, or you want me to come down here and pop the shake on Johnson & Johnson? Okay, this morning? All right, we'll come on down here. All right, let's go to this one. All right, now, this company, Johnson & Johnson, released their ER before the market opened. The same strategy applies. See, that's what's so beautiful about our strategies and techniques, which you find nowhere else. They are interchangeable. They are adjustable. They are able to be used whether or not a position, that residual strategy is able to be used whether or not a position released their ER the night before or the day of. Let me prove it to you. Johnson & Johnson, before the market opened, all right? So we come out. Watch how I move now. Very simple. J&J. Is it after 10 o'clock? It is. Now, this is a prime example. We're ready to lock and roll now. It's after 10 o'clock. All the riffraff is settled in the market on J&J. Now, this is a prime example. Bull, bear, we don't damn care. The position down, watch how I monetize this position, even though it's down. Okay? The other position was up. Call option. When we come out here, watch how I walk down this position. Is that 0.50? Yes. Red means put option is in play. Now, I walk down. Is it close to its 52-week low? No. Okay? The low for the day is 146. That's a long way to fall to its 52-week low. Okay, then fine, Kenneth. You can continue. I come down here. This is the volume per day over the last 3 months. This is the volume today. I don't have volume, but what I do have is what? Water table. And I know this damn position going to pull back anyway doing water table. Right? Water table at 11:15 is currently 10:17. Now, unlike with a call option, if I'm going to take a put option, do I take it in water table or before water table? There you go, Kamisha. There you go, Anthony. No, Anthony, no, not doing. There you go, Garnell. There you go, Jacqueline. Before. Why? Because on the front side of water table, a put option is going to be cheaper. Because, see, I like that. Let it run up. Good. Because as it moves up on the front side of water table, all right, the put option price goes down. So then when it goes in the water table and the underlying stock has a propensity to move down anyway, my put option will go up. That creates arbitrage. Arbitrage is nothing more than the differential between where you buy it and when you sell it. That's arbitrage. Now, let me pause now before I go further because we're about to put the smack down on this position and get paid. Does anybody not understand or understand anything that I've done so far or anything I've said? If nomenclature is off in your mind, come on. Got to get it now. Everybody with me? All right, let's go. Now, when I come out and look at this thing, I'm looking at it from the standpoint of, okay, I kick back 1 month. I see this damn thing running. Then that ER report is sold off. And look, right here is at 150. All right? Now, a couple of things have happened here. It hit its 52-week high also. The day right here. Yesterday. When that ER report came out today, it wasn't glorious enough to push it even higher. So what did everybody do? I told you, traders and investors are fickle. They're fair weather friends. They got the hell out and sold. Because nobody makes money till they what, Queen Jillian, King Mike, till they sell the clothes. That's what happened right here. Get it? What is trading and investing? The monetization of human behavior. That's what we're about to do. We're going to monetize their behavior when it's sold off. So now, right now, listen to me carefully now. This may sound like an oxymoron to you, what I'm about to say, but if you're a conventional thinker, you'll think of it that way. But if you are an unconventional thinker, all right, you'll catch what I'm doing and you'll be like, Look, I actually want this to run up. Because when it runs up, guess what? Is my put option going to be cheaper or more expensive? Thank you, cheaper. Then when it goes in the water table, what is this going to do? It's going, this right here, going to pull back down. When it pulls back down, what's going to happen to that put option price that I bought? There you go. It's going to rise. I'm going to get paid. Now, let me stop. Does anybody not understand and understand that? Think about it now. Marinate on that. Does anybody not get what I just went over now? Okay. Now to show it to you better not to tell you. Watch this right here. When I'm looking at a put option, I look at one above the last. One above the last. When I'm looking at a call option, I look at or below the last. Because everybody understand and understand that. Very important. Everybody got that, right? Okay. So, when I come over here and get ready to make my move on the option for Johnson & Johnson, J&J, right? I've got to go ahead and look at one above 147. Why? Because that's the last. Time is 10:22, and it is currently 10:22, so the time is accurate. So when I come over here, if I don't see the option tab, I click here. The option tab will appear. When I click on options, get off for January the 24th. I want to index off the third Friday of February. I'm here. Next, I come here. I see 147. I go the next strike price higher. Okay? Because I'm looking for a put. So I come down, and that gives me 150. Get it? That's one higher than 147. If I was looking at a call, I'd be at or below 147, but I'm looking at a put. I come over, right? Now, is that more than 0.50? Is this simple or what? Is that more than 0.50? All right. Now, this time is way off. It's not 9:32. It's 10:23. So you would go to your platform and get the right pricing, but you best believe it's up. One of my elders, go check your pricing for me. King Mike or King Al Henderson or King Gary Smith. Tell me what this last is, and I'll continue with the drill down. Thank you in advance, Kings. All right, so now, let's say that this time was accurate. And let's say these numbers were correct. All right, so we come down. Now, that volume is 10 or more, so that's fine. Okay, now check it. For those that would have bought it yesterday and implemented the regular strategy, it's at $3.95. Thank you, King Jared. So this is at $3.95 now. The intraday high, what's the intraday high on that, King Jared? Is it 434? King Jared says it's current 440. Okay, great. So the intraday high is 440. And what is it now? Everybody listen up. 440. Write this down. 440. We're going to do this right now. The intraday high is 440. And it was and it's currently at 395. Okay, so right now, thank you, King Jared. We have a spread, okay, of, I'll do the math right now. We got a spread of 440 minus 395. So you can make $45 off of where it is now. If you bought it at $395 per contract, it hits its intraday high of 440 once again. That gives you a $45 spread. There you go, Queen Zenobia. All right. But let me ask you a question. Now here we go. Listen to my question carefully before you blurt out an answer. This is a put option. Do we take it now on the front side of the water table, or do I wait until I get in the water table to take my put option? What say you, family members? There you go, Art. There you go. There you go, L. Everybody got there. There you go, Jared. There you go, Jacqueline. There you go, Leroy. So proud of y'all. There you go, Garnell. There you go, L. You take it now on the front side of the water table. Okay, now everybody listen up. Come on now. One mastermind here. Why are we taking a put option now on the front side of the water table, unlike our call options, which we were taking inside the water table? Why? There you go. One reason is because it's cheaper. Yes. But we know also in water, there you go. Here come the answer. There you go, Queen Pernell. When we go in the water table, the underlying stock is going to fall. When that underlying stock falls, the put option that we took before water table will rise. And therefore will be paid as it creates arbitrage off margin. Does anybody not understand and overstand that? All right. Now, hold on. Another component that is vitally important. When you go in the water table, unlike with the call option, where you going to set your trailer stops? You going to set them wide in the water table, or you going to set them tight in the water table? Think about it now. There you go, Mike. Claudetta, think about it. Think about it, L. There you go, Charles. There you go, Jillian. Come on now, y'all slipping. That's why we're here, though. That's okay. That's okay. Why would you set your trailer stop wide for a put option inside a water table? If you know the position, the underlying stock is going to have the propensity to go down, you set your trailer stop tight, because if anything, which is highly unlikely in this instance, but if anything happens and that damn thing rises in water table, which is highly unlikely, and you got your thing set wide, your trailer stop set wide, you won't lose that profit. But if it's set tight and the position breaks protocol and rises instead of continues to fall in water table, bam, no problem. You still got your profits. Get it? Good. Unlike with the call option inside a water table, you got to leave it wide because that damn thing may fall. But on the backside of the water table, if you have a call option and you expect it to rise, you'll still be in the position for it to rise. Then on the backside of the water table, that's when you tighten it on a call. There you go, King. King Michael's reminding everybody, you don't want to get stopped out. Now, we got tons of training webinars and reference documents on the backside of our website for you to go ahead and study on this on your own. But we're doing it live here now so you can see. See, you need to see this live while the market's open. That's why we're doing this. Does everybody get that now? Because all of our strategies They're built upon the Lego strategy, okay, or technique. Each strategy builds upon the next one like Lego blocks. And if you don't know what block or strategy to put on top of the previous one, it'll throw you off. But when you match them on top of each other, okay, accurately, oh, you wicked. They can't stop you from getting paid. And the beautiful thing is we're paid by 4 o'clock today. Today. King Sean Jackson, you with me, brother? Willie Johnson. Terrell Clements. Y'all getting this? Maurice, you mighty quiet out there, King. Queen Kim Fordham. Christian Slater. King Elder Kevin Rice. What say you? Okay. Jeffrey Bonner. Jamal. King, you've been eerily quiet. Okay? Give me some of that positive energy. J. Ron. Hugh Rose. Devon. Okay? Al Sims. King Anthony Stone. Come on, young king. Are you guys with me on this? We've got to get this money. Thank you, King Al. There you go, King Dean. There you go. All right, give me some of that positive energy. There you go, Devon. Greetings, King Hezekiah. Great, King. All right, okay, King Anthony. Excellent, King Elder Kevin Rice. See, the thing is you got to be out in front now. All right? King, writing on, don't you fool with no margin account. You do this on a cash account on. All right. Greetings, King Maurice. Thank you, King. All right. Okay. Now, the thing is, family, look, don't add or subtract from anything you see happening. All right. And let the market, all right, do what it do, is the way Charles will say. We don't care what it does. We just give you an example of getting paid if the underlying stock is going up with a positive ER, and we give you an example of getting paid if the underlying stock is going down with a negative ER. It doesn't matter. But you govern yourself accordingly without any emotion, period. Okay? Now, once again, let me pause and open the floor to any questions. I don't give a darn if it's about nomenclature used, protocol, implementation, strategy, doesn't make any difference. You got any questions, ask them now. Because this is just straight money. When I send you out that reference document on Sundays and certainly no later than Monday, where I list the ERs for the upcoming week, you ought to be salivating. Because if you stick to our ER residual strategy, you are hard pressed not to get. How can you not get paid? Hell, you let the horse start running the race, and then you determine who out front, and then you take a position on that horse. You're not like all the other fools standing there trying to bet before the race. Well, why in the hell would you do that? On the hope that you get a larger payout? No. I'll take a smaller, more consistent payout by letting the horses start running the damn race first. Then I become like a soothsayer. It's like I got a crystal ball. Yeah, I got a crystal ball, these two eyes in my head and my third eye, because I see which horse out in front. So I see whether or not the stock is going to require a call or a put. Then I come down here, and then when I see more than 0.50, oh man. All I got to do is walk down step by step of our drill down, and it's undeniable. Pay me before 4 o'clock. That's it. And then rack them up again for tomorrow, because I'm going to do the same thing to you. Family members, you know, thank you for all the positive comments, and thank you for allowing us to show you the light. Thank you for, yes, believing in us here at the Wealth Institute, but more so believing in yourself. You know, just think back about what you did not know before you joined the Wealth Institute and what you know now. And you have yet so much more to learn. You see, all of this other riffraff that they put out there, and you know, busy work and whatnot, all of that does not have anything to do with getting PAID. When you get a chance, if you ain't got nothing else to do, turn to Bloomberg and the CNBC and just ask yourself, what are they saying that will get me paid? At the end of the day, what are they saying that's going to pay this electric bill that's due this month? Or pay off my student loan, or pay this mortgage off? You see, you got to understand and understand. And I talked about this yesterday on the Classroom Not Walls radio broadcast. Be careful about becoming an information junkie. No. Okay? When you sit around and being entertained, all right, be careful. All right? Be very careful. Because when you're being entertained, you're allowing something, a person, place, or thing to inject into you. Let me make this real clear now. If you allow me to put something into you, it could be either be positive or negative. All right? That's why the colonizer has come out with creams. Listen to me now. I'm going somewhere with this. Many people are afraid of injections. They're not going to let nobody put no needle in them. See, that's entertainment. When I inject something into you. So what the colonizers said, well, you know what? I'll rub it on you. That's where creams come from. Topical application. See, that's what happens with regards to this fake information that they give you. They just rub it on you through CNBC, rub it on you through Bloomberg. All right? But it's still numbing. It's still a numbing effect. When you go to the dentist, and if you tell the dentist, don't give me no shot to numb my jaw, well, you know what? He could take a Q-tip and he puts a cream on it, and he can rub that inside your jaw, and guess what? Your whole damn jaw will be numb. Now, he got the same desired effect as if he shot you with an injection, but he just rubbed it across your tooth, and it's numb. Same effect. So when the media is running out there talking about EPS and stochastic and Bollinger and condors and all that, they're just rubbing it on you. But the same thing you got to ask yourself is, they numbing me, but I'm not getting, they're not giving me stuff that will go ahead and activate me to get PAID. So you got to become an information utilizer and monetizer. Listen to me now. Information utilizer and monetizer. And when you become an information utilizer, write this down. Write it down now. When you become an information utilizer, which then allows you to monetize that information. So now you are information monetizer, then it will allow you to become a capital colonizer. Y'all get it? Utilizer, monetizer, capital colonizer. That's what it's about now. These people aren't playing. Nor should you. Utilizer, monetizer, capital colonizer. Because if you're just looking at Atlanta Housewives and Next Bachelor, whatever that foolish show is, and all that kind of stuff, and how is that Yeah, love and hip hop and all. Look, how is that getting you PAID? How can you utilize that information such that you can monetize said information and become a capital colonizer? Ain't a damn thing they showing you in love and hip hop that's going to allow you to walk down that trilogy. It ain't going to happen. But you sit there and watch it. Just absolutely amazing to me. Insofar as you're so brilliant, you can walk down this thing right here and get paid. Bam, I know what this means. Okay, I got to get back over here. All right, let me look at the graph. Let me look, okay, boom, boom, boom. Let me look at the days, boom, boom. Okay. Instead of sitting there and looking at some fools on love and hip hop, cut the fool. And as a result, you become a fool by default. If you look at foolish things, how can you be nothing but foolish? But when you look at things that will allow you to obtain and maintain your economic liberation, it's a whole different thing. And always remember, this is gospel what I'm about to tell you. You are so brilliant, and your mind is so wonderful and fantastic and so fertile. Anything, not something, anything that you place in your mind will flourish, will become real, period. There's nothing else in the universe that is more fertile than your mind. Colonizer knows that. That's why 24/7, 365, there's a constant battle for control of the most fertile soil in the universe, your mind. Now, let me tell you how wonderful the ancestors and the Creator are. When you slumber, when you sleep, they are trying to reboot your mind, trying to defrag all of that BS that you've been exposed to by the colonizer during your waking hours. It's called dreams. Listen now, I'm going somewhere with this. When your body rests, that's when the portal to the Most High and your ancestors opens fully. That's why when grandmama come talk to you in your dreams, she trying to say, forget all of that BS you listen. Baby, I'm coming to show you this. Remember this? Or when you have premonitions, the ancestors and the Creator trying to prep you. They say, look, don't watch this tomorrow's episode of Love and Hip Hop. I'm prepping you. This is about to happen right here. Get ready. Third eye and third ear. You need to focus it on this. But see, we turn around, discard that, and focus, cut on the television, which what? Listen, tells lies visually. That's why it's called a television. It tells lies visually. You sit there and watch that. And sometimes you get so intoxicated, you get so toxic in your mind with all of the colonizers' programming that you start daydreaming. That's when the ancestors come to you during the day. They don't wait till you go to sleep. They say, I got to say this food right now. So now you start daydreaming. Daydreaming ain't a negative thing. That's a positive thing. That's an emergency procedure for the ancestors and the Creator to try to pull you out of that downward negative vortex that the colonizers put you in through all of the social conditioning and advertising and the like throughout the day. When you get so toxic, they love you so much, the ancestors and the Creator, they say, look, even though he's walking or he's sitting up in his office or whatever at their desk, we need to go get him. Put him in daydreaming mode. Listen to what I'm telling you now. So that's why you have to protect what you allow access to as it relates to your mind. People you talk to, what the hell are they talking about? What stimulus you allow yourself to be exposed to? Is it negative? What type of energies are you around? Are they positive? Are they negative? All of this adds into your well-being. Because to become wealthy is a holistic task. You've got to be ready. Listen now. Spiritually, which will lead to your financial wealth, which will lead to your physical wealth, health and wealth. Because it's expensive to be healthy physically. You know that. That's why to eat healthy costs more than buying junk food. See, all of this is interconnected. So when on Mondays or Sundays, when I send you something like this, you should be saying, tee them up. Because there ain't nothing free about freedom. I got to get paid. These earnings reports can't come out quick enough. Dr. Reed sent it to me. I'm about to what? I'm about to utilize. I'm about to monetize. And I'm about to colonize and get PAID. Any questions on this? There you go, King Mike. Okay, so now you've got this for the balance of the week. You know, even if you missed out the beginning of this week, yesterday and today, okay, tomorrow gonna be here. So when tomorrow get here, guess what you do? You come down here, right? And you sit right here. Be ready for them Thursday, tomorrow before the market opens. Do what you just saw me do. Be ready for Procter & Gamble tomorrow. Okay? Payday. Be ready for Intel after the market closes tomorrow, going into Friday morning. Payday. Then I need you to remember now, coming off of this, I need you to be rebalancing, utilizing the dogs of the Dow. All right? Here they go. You index off the top four: Dow Chemical, Exxon, IBM, Verizon. Then you come back over the top, okay, and you sit right here. And you get even more nasty with that thing. And you come over here, and you got your ready list of dividend paying positions. Are we clear on this? Let not your heart be troubled, fat brothers and sisters, kings and queens, gods and goddesses. You can and will get PAID on demand as you see fit. Whether or not you got $10, $100, or $1,000 to invest. There's always an opportunity out there that our strategies and techniques will allow you to monetize. Your money is submitted to you, and you have stewardship over your money with the sole task of putting it to work. Don't get into the conventional thought process mode where you think that you are to work for your money. No, that's ass backwards. And I'm sorry, but there's no other way I can say it. Think about that. The way they have the master's program is that they must work to get paid, all right? And then they live off of what master pays them. So now, look, hold on now. I really need to emphasize this. If you ascribe to that thought process, then you will always be waiting for massa to pay you. And you will live your life pursuant to what massa sees fit to pay you. So, in order to live, in order to get, listen now, you got to do what massa tells you to do for as long as he tells you to do it. Now, if you want to just succumb to that, then that's you. But those that know that they're kings or queens, those that know that they're gods and goddesses, they know, wait a minute, no, wait a minute. That's the bamboozle move. No, I may be working on somebody's plantation, aka job, but I am clear that whatever I'm getting paid now, that is to be put forth to build my kingdom and queendom. For I'm going to take that money that I'm getting now and put it to work. So it's generating revenue and income for me. And every dollar that I put towards my kingdom and or queendom puts me one step further away from the plantation. So I invert that damn thing. While master think he playing me, no, he getting paid. He getting played. Because every time he pays me these slave wages, I'm taking those slave wages, okay, and I am buying my freedom. My ultimate freedom. My economic liberation, because I'm taking those slave wages and I'm putting those slave wages to work to obtain and maintain my economic liberation. Do we get this? But see, you got to have that mentality, because the mind controls the behind. But if you're in slave mode mentality, okay, you sit there and you actually go to work every day, live within the parameters of what master chooses to pay you, and then you hope and pray that master think you's a good worker, you's a good slave, and gonna give you a raise. The hell? You another person, another human being determines how much you generate from revenue and income. That's crazy. Whereas when you're trading and investing your own money, who determines what revenue and income you make? You do. And you best believe nobody cares more about you than you. Okay? Master cares about you to the extent that you can aid and abet him living his lifestyle. When you cease to allow master, when you cease to make enough money for master to live his lifestyle, guess what? You get laid off. You out of here. You got to keep it real with yourself like that. Now, Mackie, you're getting cute. You've never heard me say anything about choosing an expiration date based on the open interest in the volume. When the hell you come up with that from? What does the open interest in the volume have to do with an expiration date, Mac? See, it's that kind of stuff where you want to get cute and you want to deviate from what has been proven to work. That ain't got nothing to find me one reference document or one webinar that I've taught where we talk about the expiration date having anything to do with open interest and volume. So the answer to your question is hell no. Not just no, hell no. Your expiration date is indexed off the third Friday of the month. And if you're less than 10 days to, out or 1 week out, you go to the next month. Now that's on every one of our option videos and in our reference documents. Are we clear on this, brother? Are we clear on this? Thank you. Now, believe it or not, I'm glad you asked that stupid ass question. I'm calling it that on purpose because I want to drive home the point to you, King. You're brilliant. Don't get distracted by that riffraff. And if you really think about your question, you would understand and understand contract, that ain't got nothing to do with your contract expiration date. See, that's a prime example, everyone, of making arithmetic trigonometry. Because we come in here and work so hard and you see how simple it is to do, you say, wait a minute, maybe we need to put a little bit more spice in this gumbo because see, it can't be this simple. No. Leave it like it is. If you see it, if you see me come in here real time and do it, and you ain't never heard me say anything like that, then no, that's not supposed to be in the recipe. All right? That's not supposed to be in the recipe. Okay, King Mackie. Appreciate love you, brother. Thank you, Lau. Thank you for allowing me to give you some tough love here amongst everybody else. But see, that's how diligent we got to be. Okay? Stick to the status quo. Stay in formation. Don't add. And I had just said, King Anthony Stone said, thank you, King Mackie, for that question. Absolutely. And I had just said previously, don't add or subtract from anything you see me do here. Okay? Excellent. Now, family members, I want you to go out into the rest of the day, and as you monitor the markets, look at what they are and are not doing. Understand and understand, once again, trading and investing is nothing more than the monetization of human behavior and the minimization of risk. That's all we're doing here. We're letting them do what they do, then we monetize. All right? Trailer stops and stop losses up under us to minimize our risk. And we stay out in front of the market. And no matter what they may do, no matter how illogical it may seem to be, it's monetizable. Because not something, but all things are monetizable. Family members, like always, a great Ask Wiz Wealth Institute Virtual Trade Room tomorrow now, Thursday, 8 to 9:30 p.m. Eastern Standard Time. Another Ask Wiz Wealth Institute Beginner Traders and Investors webinar, episode number 122. Or do we have some information for you that you can put in your reference document notebook that will allow you to continue to get PAID on top of all of the other information you have in the past and the plethora of information that you're going to have in the future as you continue to be a member of our beloved Ask the Wiz Wealth Institute family. Be on standby for your PAID alerts and the Wiz alerts as the market dictates, and understand and understand that we are indeed your community service. This is your humble servant, Dr. Kenneth Wiz Reed, saying peace and blessing be upon each and every one of you, and know that we have, will, and continue to do all of this for the love of YOU, our beloved Ask the Wiz Wealth Institute family. Peace and blessings be upon each and every one of you. This Ask the Wiz Wealth Institute Virtual Trader Room is now dismissed. We do it for the love of each and every one of you.